Hi, I'm Connell from If Advice, and in this video we're going to quickly explain what is capital gains tax. So, capital gains is when you sell an asset or investment for more than you paid for it. A great example is you buy a property for $400,000 and you sell it for $600,000. That is a capital gains of $200,000. Now, how much tax you'll pay depends on a few factors. First one is the cost base, who owns the asset or which tax zone it's in, and 3, how long you've owned the asset for. The cost base. This isn't just what you paid for the asset, or in this case the property. It's what you paid for the property and any other expense incurred during the purchase. A good example of this might be the stamp duty on a property. If you've paid $10,000 in stamp duty, the $400,000 property would have a cost base of $410,000. The ATO has a really great website that explains this, but for more information, this is a bit of a detailed category, but your best bet is to have a chat with an accountant to get this exact figure. The next consideration is who owns the asset. Now, if you haven't seen it yet, go check out my video about the 4 different tax zones because I kind of go into this in more detail. But the short version is whoever owns the asset, it's their tax rate that is used when calculating how much tax will be paid. If it's an individual, it's up to 45%, where if it was a company, it might be up to 30%. And at number 3, how long has the asset been owned? Depending on how long you own the asset, you may get what's called a CGT discount. So if you've held the asset for more than 12 months, the discounts look like this. If you've owned it in your personal name, you'll get a 50% discount. If you own it in a company name, you don't get any discount at all. If you own it in superannuation, in accumulation phase, for more than 12 months, you get a 33% discount. And if you own it in super in pension phase, you'll get a 100% discount. Now, I find this makes a lot more sense if we use an actual example. So, same scenario, properties bought for $400,000, purchase costs of $30,000, which makes the cost base $430,000. With a sale price of $600,000, your capital gain is $170,000. Let's say this person held the property for 2 years and as an individual, and therefore they qualify for the 50% discount. Therefore, the net capital gain is $85,000. So we've worked out the capital gain of the property, but we haven't worked out the tax you would pay. How you do this is you get that capital gain of $85,000 and add it to the individual or the entity's tax return for that year. Depending on the tax rate, depends how much tax you'll pay. Let's take someone who's on $80,000 per year. Without the capital gain, their annual tax bill would be about $17,500. But what we need to do is add the $85,000 to their $80,000 income. So we give them a total income of $165,000 for the year. Now their new tax bill is $48,500, which is an increase of about $31,000. So that is your capital gains tax that you'll actually pay. So the property had a $170,000 increase, but we only paid $31,000 in tax, which is roughly 18%. So if you're trying to work out capital gains tax for yourself, just remember those 3 things. You've got to try to work out the cost base, what tax zone you're in and how much tax you're going to pay, and if you qualify for that over 12-month capital gains tax discount. Of course, this is all just rough workings. I definitely encourage you to talk to your accountant or a financial advisor to get the exact details. And also there's a couple of other things that you can do to reduce your tax. So hopefully that's helped. Follow, like us on Facebook and YouTube because there's plenty more videos coming. Thanks.